We have breaking news, ladies and gentlemen. It is confirmed Fed Jerome Powell just went full tilt to the bull side. He showed no regard for concern about the recent rise in inflation. In fact, he showed no concern for anything. The economy is strong. Inflation is continuing to progress in the right direction. We're still expecting 3 rate cuts in 2024. Now, albeit they did raise the neutral rate, the long-term rate, from 2.5% to 2.6%. The markets didn't care too much about that. It was really all about how many rate cuts we're expecting in 2024 in relation to the renewed spike in inflation that we have recently seen. But let me tell you right now, what I got from Fed Jerome Powell today is he is looking for any reason to justify cutting rates. A lot of times. He made some specific references quite a few times throughout the speech, almost as if Powell knows something, or maybe he does. We'll talk about that here in this video. But what does this mean for Tesla stock, small caps, and the broader markets? Guys, we have a lot to get into. Jerome Powell has turned on that money printer yet again. The bull market lives on. Let me know what you think about all of this information down below in the comment section. Is this bullish? Is this bearish? What do you think? Let me know down below in the comment section, and let's get started. So let's start with the dot plot. Let's give the bears something first, because there's definitely a bearish argument for our markets right now, and I'll do my best to give you both sides of this, and of course talk about what I think is going to happen next for Tesla and the broader markets. But here's a quick summary of the SEP, Summary of Economic Projections, also known as the dot plot. So the Fed thinks the economy is going to be red hot in 2024. They raised their GDP estimate from 1.4% to 2.1%. That is a huge jump since the last Summary of Economic Projections we got on December 13th. They lowered their unemployment projection from 4.1% to 4%. Their PCE estimate stays the same at 2.4% by the end of this year. And core PCE, their estimate, actually went higher from 2.4 to 2.6%. The part that the markets really liked was the federal funds rate projection stayed the same at 4.6%. So you're still pricing in 3 rate cuts in 2024. What's actually interesting about this is if you look at this column right here where my cursor is, I'll scroll down so my head's not in the way, but this is the range. So it's showing you the lowest dot and the highest dot for all of these categories we just went over. And this bottom one is for the federal funds rate for 2024. Well, it's actually wild that you're still pricing in 3 rate cuts, because the lowest dot back in December was 3.9%. That means one official at least expected Fed funds rates to be 3.9% by the end of 2024. Well, now the lowest estimate is 4.4%. So even the most dovish Fed official is expecting higher rates and less rate cuts. Now the highest end dot is still at 5.4%. So some Fed officials believe there's not going to be any rate cuts in 2024. And, well, this is actually the dot plot here. You can see the median is right here. It looks like 2 Fed officials are at 5.5% by the end of this year. 2 officials expect 1 rate cut. 1, 2, 3, 4, 5 officials expect 2 rate cuts, and the majority expect 3 rate cuts. Now, 1 person is expecting 4 rate cuts. So you actually did get this lower guy down here, this dot, that actually went up quite a bit. This dot, presumably, was down here at the last Summary of Economic Projections, and we can actually go ahead and take a look at that as well. So 2024, yep, the dot was down here, and these were way more spread out. So you still had the 2 people at 5.5%, only 1 person that was expecting 1 rate cut, and what looks like 1, 2, 3, 4, 5 officials that were expecting 2. and 6 officials that were expecting 3. So today you have 1, 2, 3, 4, 5, 6, 7, 8, 9 officials expecting 3, and 1, 2, 3, 4, 5 officials expecting only 2. So in the camp for 2 rate cuts, you actually went from 1 official to 5 officials. So people did get more hawkish in this latest summary of economic projections, but the estimate for 3 rate cuts is still the median target. So that's actually fascinating, but that's not exactly what is bearish about this summary of economic projections. 2 things of note that are bearish. It's 2025. The estimate in December, the last summary of economic projections, was 3.6% for the federal funds rate by the end of 2025. Now it's 3.9%. So now you're only pricing in 2 rate cuts in 2025. But the thing that's really the most bearish here is the longer run rate. This column, it stayed at 2.5% for a long time. That was actually just upped to 2.6%. So your long-term neutral rate just went higher. So that means you're probably not going back to the easy money policies that you were at during COVID anytime soon, if ever. But then Fed Jerome Powell said this. He said, "My instinct is rates won't go back down to very low levels we saw before." Followed by, "But there is tremendous uncertainty around that. So maybe we do start to go into a recession and we go down to ultra low interest rates again." That's kind of what he's saying would happen. Fed Jerome Powell also made this comment, which is notable. He said, "If there were a significant weakening in labor markets, that would be a reason to start rate cuts." I think everyone already knows this. If the economy were to plummet and we were to get some kind of bad jobs number, the Fed at the next meeting would likely start to cut rates. The Fed officials would come out and say, we've seen enough progress on inflation. We're starting to get some weakness in the labor market. We can start cutting rates potentially at the next meeting. The markets would price that in. The Fed would start cutting rates. But the way that Powell was saying this, and I don't think the quotes actually do it justice, but if you were listening to Powell, it sounds like he wants to cut rates really bad. He said, "We are not going to overreact to these 2 months of data, nor ignore them." And like this comment says here from above, he said they literally just ignored them. Then that's exactly what happened. Now, I was expecting you would get some kind of pushback from the Fed. Something about raising rates if inflation does continue to run hot, but you got nothing even close to that. I guess Powell really didn't get asked about raising rates again, if that would be a possibility. Maybe he would have said yes, but he didn't even get asked. Powell also said, quote, "I don't think we know if rates are going to be higher in the longer run." So the summary of economic projections said they're going to be a little bit higher than we previously thought. And then Powell comes out and says, "We don't know. Maybe they go back to being super low." It's almost like he knows the economy is going to weaken or knows something that we don't. I mean, let me know down below in the comment section if that's what it felt like to you. Jerome Powell today was cool as a freaking cucumber. Not a worry in the world from this guy. And I believe if you were to get Powell in a room off the record, he would tell you, yeah, I mean, we're just waiting for the first sign to start cutting rates, but we haven't got that yet. Jerome Powell also reaffirmed that you could see more participants enter the labor market, the economy doing well, that does not necessarily or will not necessarily transfer into higher inflation. So the Fed doesn't seem too concerned about strong economic activity at this point. And I think this is something the markets really loved as well. He said, ultimately, we do think financial conditions are weighing on economic activity. Now, if you look at any kind of sentiment gauge out there or financial conditions index out there, you're at some of the loosest points that you have been at in a very long time. Now, this is granted including stock markets, crypto markets, credit spreads, the availability of credit from banks. This is including all kinds of different metrics. I think Powell's specifically talking about the lending market, in which the Fed funds rate, the Fed has effectively crushed the lending market, whether it's real estate or autos. Those things are not in a great place. And the markets really took this as markets are not too high. The Fed doesn't care about markets. The full-on bull is here. Jerome Powell even tried to push back on some of the seasonal effects of the first couple of months of the year. Fed Jerome Powell said, quote, "We tend to see a little bit stronger inflation in the first half of the year compared to the second half of the year." He also says many saw seasonal possible problems in the January inflation print, meaning that your one-time yearly price increases, a lot of the time they happen in January, if not in February. Now, Powell said January's inflation report was quite troubling. He said February's inflation report was a lot better, but still high. He did say the Fed needs to take some time to assess if recent inflation represents more than bumps in the road. He said this a while back, and people largely dismissed it, but he said it again. He said for a long time now that there's likely to be bumps in the road, that it's not going to be a straight line down on inflation, that there's going to be periods where inflation might go up, it might go down, but trend down nonetheless. And he basically brings up that argument again, that maybe these first 2 months are a bump in the road, a roadblock, if you will, on the path of inflation falling, and that they really need to see if this is just a bump in the road or something more that they would need to address. But still, no talks at all about raising rates. And I think you're going to have to see really bad inflation numbers, like a surge, a straight up surge in inflation to get the Fed to even think about cutting rates again. Now, if you're someone that thinks inflation is going to rise again, this likely just means the markets are going to fall a lot more, because the markets are not going to be prepared at all following this Fed that we've seen today. The Fed is basically banking on inflation falling again, that this was just a temporary bump in the road. If it's something more than that and inflation continues to come in hot, then I think markets are going to have a huge problem, because we're not priced for that at all. Jerome Powell really reiterated how strong the economy and labor market are as well. He said, "I don't see cracks in the labor market." And when Powell was saying this, it was almost like he wants to see some kind of weakness out there. He wants to see a spike in initial jobless claims. He wants to see a crack somewhere so we could justify cutting rates. That's at least how it felt when he was saying it. And again, these quotes don't give it that much justice. You can watch the recap from Powell if you would like to. You're going to see a confident Powell up there. He was so confident inflation is continuing to fall. It's like, he must know something, right? Because I don't think anyone else is that confident inflation is continuing to fall. And it just sounded like he's looking for a reason to cut rates at this point. Fed Jerome Powell said, "We are closely watching layoffs, and initial claims are very, very low." Now, on the balance sheet, we did not get any new information on the balance sheet. The Fed did not change anything. The Fed did reference the reverse repo market quite a bit, and this is something I have talked about. This is really a good way to monitor the excess liquidity in our markets that can help soak up the Fed's balance sheet running off. The Fed reaffirmed what I think the markets have thought as well, that when the reverse repo market gets to zero, the Fed would basically have to stop running off their balance sheet. Or in other words, if excess capital, let's say, is $10 billion a month, then the Fed could run off $10 billion a month in treasuries. Jerome Powell said they think it's around a 1-to-1 ratio. And that's really what he said right here. He says, "We will be monitoring money market conditions carefully to know when to stop on balance sheet runoff." Fed Jerome Powell says, "We're watching indicators that foreshadow 2019's turbulence. It will mean we run much less risk on liquidity issues." So at the first sign of there being a problem, QT is gonna stop. Jerome Powell said we are looking at incoming inflation data most importantly. Fed Jerome Powell really pushed back on the wage price spiral argument as well. He says wage increases are gradually coming down to levels more sustainable over time. So what's the bottom line with the Fed? The Fed was bullish as hell, okay? They're looking for a reason to cut rates. They're not finding one. Good news for the economy. Consumer is strong. Good news for stocks. I think a lot of people forget the economy is number one. The Fed is number two. If you're thinking about this on a 12-month time horizon for that matter, the thing that really matters is whether or not the economy goes into a recession. Now, the Fed can have big impacts in the near term, but when earnings come out and they're better than expected and the fundamental valuations are supported, that's always going to be most important, and the Fed is going to be second. So, I mean, good news there. Economy is doing well, and the Fed expects the economy to continue to do well, and the unemployment rate, well, they lowered their projection there also. Again, I want to clarify this. It looks like the Fed is looking for a reason to start cutting rates. Bad news is with the dot plot, it looks like the longer term federal funds rate is going to be higher, less rate cuts in 2025, but we still held on to the 3 rate cuts in 2024. And that's the thing the markets were really paying attention to. If we would have came in with 1 or 2 rate cuts in 2024, the markets would look a lot different right now. That did not happen. So that is bullish as hell. Now, the other thing to consider is it's going to really depend on the data. If the data goes back to kind of the trend of what we were on, inflation falling, we're going to get that first rate cut likely in June. If the next CPI report is really good, we could get that next rate cut, that first rate cut in May. And that's a really good thing for stocks as well. Now, as far as the balance sheet, based on what we can judge, how many reserves there are in the Fed reverse repo market, it looks like the Fed can only reduce their balance sheet by roughly another $400 or so billion. It looks like at the next meeting, the Fed said very soon they're going to start reducing the balance sheet, basically implying that by the next meeting. That's also great news for the bond market. Less selling pressure from the Fed means less selling pressure on bonds, which means less pressure for bonds to fall, which means potentially less upside pressure on yields. Now, we still don't know what the dollar amount's going to look like for the new QT. We're currently running off about $60 billion in treasuries a month and running off about $35 billion in mortgage-backed securities. So maybe that looks like $10 billion or $20 billion to treasuries, $5 billion to mortgage-backed securities. It's likely to be quite a big drop. So that's bullish as well. And again, I just want to say for like the 10th time in this video, it looks like the Fed wants a reason to start cutting rates. It's probably political. Let's be honest. There's a lot of people calling on the Fed to lower rates right now. And I think if young Biden did the same thing as Trump did back in 2018, 2019, and basically told the Fed to cut rates or I'm going to fire you, you'd be getting rate cuts at the next meeting. That's not happening right now. He's not getting that much pressure, but the pressure is definitely on to start reducing rates before the election. So it looks like no matter what, you're going to get some rate cuts coming here pretty soon. All of this is really a perfect storm for equities. It's a perfect storm for a stock like Tesla. You're getting rate cuts. Economy's doing well. On the adverse side, if the economy stops doing as well, you're going to get more rate cuts. The Fed's going to start reducing their balance sheet. The economy's so strong right now, even if it did weaken a little bit and we got more rate cuts, a little bit of weakening here, that's fine. You're far from a recession. The labor market is still doing fine. Now, some of you guys might say far from a recession. Oh my gosh, that's not true. That's what the data says. Okay, I'm with you. The lower income consumer, people you may know that just have average jobs that work at Dollar General or McDonald's or other places, they're feeling the burn. They're feeling the hit. It sucks out there. I get it. That might be you. That's me. It sucks, okay? If you're not doing very, very well, The cost of living is expensive. I get it. I understand. But from the market's perspective, this is the perfect storm for stocks to continue to go higher. Now, a couple different points I want to make there before we talk specifically Tesla. Equity markets are fully valued right now. You're not buying stocks at a discount. There is no discount out there in the markets. So to some degree, I think there's a lid on how high the markets can rally here for the broader NASDAQ or the S&P. Really in your big tech names. If you get a large move higher in the SPY or triple Qs, it's probably not going to be from big tech. It's likely to be this catch-up trade. That's really where I want to highlight to you. If Tesla starts to rally, if small caps start to rally, the broader S&P and the NASDAQ, not just your top 10 names in both of those indexes, well, that's where you could get a broader push higher in the markets. And that's what I'm expecting to happen. Now, I have been very clear about this. Typically, when you see a big leader in the markets, whether it's big tech, whether it's biopharma, whether it's small caps hasn't happened in a long time, but back in like 2017, right, it was your biotechs, your small caps that were really leading the way. What happens when you get one sector doing way better than the other is ultimately the sector doing well comes down and comes back to reality and matches big techs, for an example, in 2017, 2018, or like you're seeing right now, big tech's done very well. If you get this perfect storm for small caps, you're likely to see small cap stocks start to catch up. I don't know if you're going to see this parabolic rally and get small caps that catch up to big tech and see 15, 20% rally in small caps. I don't know if that's going to happen, but I think you do see a big outperformance here of your Russell and interest rate sensitive names like a Tesla. And let's just be honest, besides the longer term federal funds rate ticking up a little bit from 2.5 to 2.6%, who cares? Not a big deal. This is the perfect storm for interest rate sensitive stocks to thrive. If Russell, Tesla, stocks like that are interest rate sensitive do not do well here, then I think you have a deeper problem in the markets. And I would be a lot more concerned if you continue to see big tech really outperform. That's not my base case. I'm expecting tech to underperform. Tesla, small cap stocks to really outperform here over the next couple of weeks. There's just not a whole lot to send stocks lower from what we got today. Now, I also think with this perfect storm argument, because that's what it is, let's call it what it is, there is a lot of money on the sidelines right now that needs to get back invested into the markets. If we do get a Fed that starts cutting rates and the economy is doing well, that's a problem for people potentially in money market funds, in treasuries, and other areas of the markets. You can see there's almost $6.4 trillion in money market funds alone. That is over 3 times the market cap value of NVIDIA, just for context. Or well over 3 times the market cap value of the entire Russell 2000. Well-known investors like Tom Lee have been calling for a 50% rally in small caps in 2024. If there was ever a time for that to start, it would be right now. Now, the logic behind small caps is really the Fed's cutting rates, economy is doing well. That's a very good backdrop for interest rate sensitive names to outperform, which are your Russell names. Now, Tesla is also an interest rate sensitive name. It looks like here in after hours, you're breaking above this uptrending line of support. This was previously support. You even bounced at almost this level back here on February 5th. You get above this 175 level, you have a pretty clear shot back to the 190 level. You get above that, and you could potentially fill the gap down, the gap that you've seen on March 4th. And I think over the next couple of weeks, that likely could happen. Now, question is, do you get good news from Tesla? If you get any kind of good news in this market environment, that's a recipe for Tesla to go up a lot. Now, Tesla stock was up 2.5% today in regular trading, up 0.61% in after hours. I actually think there's a decent chance you could go through a short squeeze in Tesla if you do get good news. We're waiting for layoff news. We know that could be coming right around the corner. Tesla's been looking into how much of their staff they actually need, if they could get rid of some people here and there. I know it sounds unmoral, especially in Tesla. If you guys have kind of a sentimental value towards Tesla, you don't want to see Tesla employees getting laid off. At least I don't. But that would be good for the stock. Some of you guys are like, lay them off, give us some good news. Yeah, I definitely understand that aspect as well, as Tesla stock is really underperformed. My point is, any news you get right now for Tesla with this backdrop, I mean, you get layoff news tomorrow? Oh boy, Tesla stock's likely up 10%. Why I say you could see a mini short squeeze-like event in Tesla is because the short interest in Tesla is at the highest point it has been at in a long time. You're 3.5% sold short. Based on all of the shares outstanding, 3.5% are sold short. That's a lot. The dollar amount today is $16.42 billion. Currently in short positions. This hit a low at about 15.2 billion just a week or two ago, and Tesla stock has rallied about $10 and short sellers lost 1.3 billion. If you're looking at it like that, short sellers could start losing a lot of money if Tesla stock does go higher from here. And after today, there's a really good reason for Tesla to go higher from here. Now, what you've seen today was a lot of shorting activity in Tesla. Even though Tesla was really green, look at the cost to borrow fees. Cost to borrow fees around 14% for the cost to borrow max. That's the highest I've seen cost to borrow fees in a long time. So I think some shorts were betting that Tesla would fall today and see a really bad next maybe couple of days. Quite the opposite happened today. Let's be honest. So I think especially the shorts that shorted like today, yesterday, recently, probably are going to get out of their short positions before they're taking $20, $30 losses every share that they shorted, right? Let's be honest. If Tesla rallies like $25 from here, that's only going to put Tesla back at $200. You could see even more upside from that. But if you shorted 1 million shares, let's say, you're going to start losing a substantial amount of money when Tesla stock goes higher. Now, here on the day today, as far as the option activity, you can see the bearishness reflected here. You had 604 orders totaling $795.92 million with a positive order value of 27%. So hedge funds and institutions were not bullish at all. Now, if you also look at the RSI is at 43.05. So you're still under the neutral level of 50. So you're still really, really bearish for Tesla. The relative strength is low. So in this market environment, with this news that we just got, wouldn't be surprised if Tesla's RSI could head back to the 60 range over the next couple of days, next week or two, and that would likely again push Tesla stock back into the 190s. That's my base case. Best case scenario could be back into the 210s, 220s even, depending on what kind of news we get. If you get layoff news, Tesla's, in my opinion, going over 200. On a pretty short-term kind of basis. Short-term notice, if you will. The RSI also looks like it wants to cross again and go positive. Not quite there yet, but give it by tomorrow, and the MACD is likely to be crossed and in bullish territory. With that said, we will still have some data coming out tomorrow morning with initial jobless claims. Maybe Powell already knows that number is going to be high. At least I wouldn't be surprised based on his tone today. Consensus is around 215,000 initial jobless claims. And wouldn't be surprised if that comes in higher. You will also get Philadelphia Fed Manufacturing Index, expecting that to come in at negative 2.3. Continuing jobless claims, as well as Philly Fed Business Conditions, Philly Fed CapEx Index, Philly Fed Employment, Philly Fed New Orders, and Philly Fed Prices Paid. New orders and prices paid are the most important, specifically prices paid. If that were to come in weak, that would be a really good sign for inflation. You will also get at 9:45 in the morning, S&P Global Composite PMI, S&P Global Manufacturing PMI, and S&P Global Services PMI that will be coming out, as well as existing home sales for February and existing home sales month over month at 10 o'clock in the morning. Fed Bar will speak at noon. You do have a 10-year TIPS auction. Those are inflation protected treasuries, so that really shouldn't do much there. And then at 7:30 tomorrow night, you do have the inflation rate for Japan coming out. Considering Japan just raised rates for the first time in 17 years, that could be a little bit more important for the markets. But here in after hours, Tesla stock is taking off, up 0.71%. And I think there's a lot more green to come from here. Let me know what you think about this information down below in the comment section. Also worth mentioning, Micron had pretty good earnings today. Micron did very well. Maybe part of that was Jerome Powell today. Definitely helped things out quite a bit. Can't downplay that at all. But coming tomorrow, pre-market, you have Darden Restaurants. Really, that's like Olive Garden. If they have things to say about inflation, it could be important to watch, but it's not going to move the broader markets. But Thursday and after hours, you have Nike, Lululemon, and FedEx. These guys are really bellwethers of the consumer. If these guys are not doing well, then that's not going to be great, especially FedEx. If FedEx is not doing good, you probably have a problem with the consumer. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.